The key for this meeting is not about tomorrow being 25 or 50. That is irrelevant. What matters ultimately is what comes after tomorrow's cut. Okay, we know they're going to cut by at least 25. We're not sure if it's 25 or 50, but that doesn't matter. What matters is, what do they do in November? What do they do December? What do they do for the entire 2025? And that's where today's discussion is going to go. And that's what the market wants to understand. Why? Well, because right now the market is pricing in a very aggressive rate cut cycle from the Fed already. And we'll talk a little about that when we get to the expectations and, of course, the pricing. Okay. Now, one of the key things we want to understand tomorrow is, does the Fed choose to take that insurance cut? Do they go for the 50 basis points now because they are concerned perhaps there could be a little bit more of a slowdown, or at least the trend of slow labor market could continue between now and the election coming in November? Okay, so keep in mind the next meeting will be 2 days after the election result. Now, do note what has scared them, what has changed all of a sudden in the last 3 months. Well, it's quite simple. We had the shock report in early August, non-farm payrolls. It triggered the so-called SAM rule. In a basic sense, effectively, this rule, whilst it's had a limited use in history, it's never been wrong. And it did trigger that we are in a recession. Okay, the market got very excited by the SAM rule being triggered, despite Miss Sam coming out herself and saying, don't get too ahead of yourselves. But since then, of course, we had the September NFP print. And whilst that didn't confirm and guarantee a 50 basis point cut, it did show this continuation of a slowing labor market. And that's what the discussion is going to be about. Is there a concern that the slowing of the labor market is likely to continue or not? If it is likely to continue, the Fed has got a very restrictive policy stance at present, and they have a lot of room to cut rates to get back down to that long-term neutral rate that they talk about, which is 2.6%. Okay, so the way to look at it, if current rates are 5.25% and the neutral rate, in other words, non-accommodative rate or non-restrictive rate, is 2.6%, that's a lot of rate cuts they can do to ultimately get the economy back to a point where they can safeguard the soft landing. Okay, now the other side of the equation is inflation. Has the risk gone or not? Okay, inflation risk has definitely not gone away. Inflation is quite sticky around the PCE, around 2.5%. The Fed has acknowledged the stickiness, but they've also told us that it's less about the month-to-month changes now in inflation and more about where they think inflation will be 12 months from now, 24 months from now. Okay, and Powell did tell us that he is very confident now that inflation is back on track to get to that 2% target over the forecast horizon. Okay, very, very important to stress. It's not about inflation being at 2% this year necessarily, but rather over the forecast horizon. Okay, so do they ultimately see the inflation risk now as balanced? Or is there a concern that if they were to begin the process of cutting rates aggressively, is there a risk that, of course, inflation does become embedded, it becomes a little bit more sticky, and they cannot get it back to target without a more restrictive policy stance? And that's what the discussion is going to go about.